Hello, everybody. Welcome to Coach's Playbook. We're rolling back the clock to the early 1980s today to talk about a little inflation, which is the term du jour. But first, Mick, I understand you have a trader shout out for us.
Yeah, big shout out, John Fasone, up 11,600 today, trading the S&Ps. Just had a great day,
That's
timed everything
phenomenal.
very well. Yeah.
Yeah, that's a really nice day. So I'm going to start this talk today because there really has been a lot of talk lately about inflation is kind of on everyone's minds. Front page of Wall Street Journal. Janet Yellen weighed in on it. Dan, I'm going to let you explain this, but I'm going to give a caveat. All right. People have thrown themselves against the wall of inflation coming for close to 40 years now, right? The last time we really had inflation was late 70s, early 80s. Crazy inflation back then due to a number of factors, including supply oil shocks. So, Dan, give us a little bit about what's happening right now to kind of set the table.
I mean, where do we start? We're technically still within this pandemic. We've been printing money like it's our job. I'm looking around, and it's just not a conversation here in the United States. Saudi Arabia's inflation's up. I'm seeing talk about Zimbabwe inflation skyrocketing. So this is happening around the globe right now. Inflation is increasing. You're seeing a lot of different factors come into play. First off, you got Janet Yellen back in the mix. We thought she was gone, but she is back, and she has a lot to say about what's happening. Rates are at all-time lows. With that happening, people are concerned that if we maintain low rates, that this inflation is going to increase. And what is inflation? Well, when we start talking about inflation, that cost of milk is increasing. Everything gets a little bit more expensive, and our dollar is weakening. So we've got a dollar that's at a 3-month low right now. We just ticked the low from February 22nd in the dollar. You've got gold. Kind of everyone's looking at that as a hedge. It'll go to my quote that I have for this afternoon from JP Morgan. We're going to talk about gold and what gold really is. So you've got metals across the board. Copper skyrocketed yesterday. Copper's taking off. Silver's to the highs. Gold finally back on track. We're broke through that psychological level of 1800. And what are they doing with rates? They're not changing them. They're not touching them. So more and more people are just going to go out and keep borrowing and borrowing and borrowing because it's cheap to borrow right now. So you're just creating this big, massive pot, and we're stirring it all together, and we're all going to get smacked in the face one of these days, I'm sure.
Yeah, Paul Krugman said the exact same thing.
He took it from me.
Yeah, I gotta say, as we embark on this, because I'll be sort of the person that will act to maybe throw a little cold water on this. I listened in preparation for this. I had heard excerpts of what Yellen said, and then this morning I actually watched her explain what she was saying. And I was expecting a lot more doom and inflation gloom, but I think that we have gotten so used during the pandemic, but honestly, going back to the Great Recession with the Fed talk being so dovish that the slightest, all she really said is that we could see some transitory inflation that's due mostly because we have all this pent up demand. People haven't had anything really to spend their money on. There was no consumer confidence. It's coming back. So we're going to drive up prices as people start to spend again. Now, when we talk about all these things, yeah, copper, oil, they're up about 30% this year, which is a lot. But I mean, oil is just back to kind of where it was before, right? Where are we at, Mick? Mid 60s, somewhere around there? I didn't look at it.
Yeah, oil's trading 65 even right now.
That is mid 60 on the dot. A few points for Jack there. I guess
he's sitting there looking at a chart of it right
now. That would be, I wouldn't put it beyond me. That's not what I am doing. That being said, though, I'm going to need a little bit more evidence before I start making moves. And we'll talk about some things you can do to take advantage of an inflationary environment. Hint, not a ton of options there, but I know since the Great Recession, which is kind of when I became aware, involved in the markets, there's always this drumbeat of inflation going on, and it's never come. So does anybody have any thoughts on why this time might be different, JD?
Yeah. First, I'm not gonna lie, I kind of forgot Hogue was out, so I didn't prep any talking points. I'm gonna go super high level here, you know.
Hogue's out burying gold in his yard.
The economy's still fat on stimulus money. We're still dealing with supply chain issues. Wages are going up. Like you said, commodity and energy prices are going up. We're seeing it at the grocery store and the gas pump right now. I think there's literally like a gas shortage going on in South Carolina at the moment.
We got a little pipeline cyber attack thing going on there.
Yeah, that was a new one.
Yeah. It's kind of wild. And
Russian hackers.
I'm no expert on grains, you know, but I know they really don't tend to make highs during the planting season. The harvest is still, you know, a ways off. There's a lot of weather reports on the horizon, so I don't think we've seen the end of a grain rally yet either. But I think we'll touch more on that next week, I believe.
I'm excited for that one.
Yeah.
Well, I'll throw it over to Mick, but I think that the most important, since the vast majority of our traders do trade indices and products that are pretty sensitive to inflation. And by that, I mean, oil's the obvious one because it is literally a commodity. But I think, Dan, most of our traders probably trade the NQ or the ES. And the ES, because it's market cap weighted, has been heavily skewed towards a lot of these growth stocks. Now, during inflationary period, this is what we've seen the last couple of days. When people expect inflations, growth stocks get hammered because their profitability, the money that they're going to be bringing in, is way far out in the future. And inflation is going to make those less valuable when you discount it. The companies that go up are kind of shitty value stocks in some way, because the idea is that they don't normally have any pricing power, but now they're going to have more pricing power. So that's where you're seeing that weird situation yesterday where the NASDAQ's getting hammered and the Dow was up for at least a while. I didn't look at the Dow when it finished because I'm not in my 70s, but
Jack's full of them today.
I'm amped up, man. I'm in the office. We get to talk. I feel on more firm ground when we're talking about economics than some of the day trading stuff. So, Mick, you traded grains for a long time. Did you ever get to do it through any? I presume you didn't through any inflationary period because there really hasn't been any.
No, I haven't. Started trading grains in 2008, and it's really something, I've been watching them lately over the last year, and I don't want to get into it too much because I know we've got a special guest coming on to talk grains with us next week. But I mean, these markets, wheat, corn, beans, we've seen tremendous moves in these products over the last, year or less. And definitely, come to some levels that, we have not seen or, haven't seen in a long time. So, like JD mentioned, we're not even in the harvest yet. Granted, they are harvesting the winter wheat. That's something they're pulling out of the ground in the springtime while they're in there getting the row crops like corn and beans planted. But I think it's, like we were discussing, or like you guys had mentioned, most of our traders in the funded accounts are looking at the S&Ps and the NASDAQ. And there's really some other products that are providing great opportunities out there, like these grains. As far as the inflation stuff goes, one thing that we can't lose track of is, this U.S. debt, which is, now at roughly $30 trillion. Going back to 2008, when I did start, trading the markets, and I was, started becoming conscious of the debt, after college and starting to think about the business world and trading and stuff like that. I think our debt was at 13, 14, 15 trillion at that point. So in my trading career, or my career in this business, we've seen our U.S. debt double. And I think that's something that we need to, be looking at when we, have the inflation discussions.
You're really going to like my quote that I got today.
Through my entire career in trading, I was trading treasury bonds and treasury bond futures. And naturally because of when I started, which was 2009, it was always an environment of ever decreasing interest rates. And it makes sense, just like anything else, that that your debt's going to go up, because really it's the cost of servicing debt. The US right now has a great deal as far as debt goes, right? I mean, they can borrow, just look at whatever the coupons on the 30 years that they're auctioning, what they get from the yield was 1.5%, and now it's creeped up to like 2.6 or something like that. But it makes sense to borrow a lot then. But from an economic standpoint, if inflation starts creeping up, they're going to have to give higher yields on those, and that limits how much they could borrow because it'll cost more to service it, right? So I'm not so worried about that yet, but if that becomes a problem, that could be a huge issue for the economy, right? Because the only way to fight inflation is raising interest rates, and we all know what that does to a lot of those indices everybody likes to trade. They go down.
I think that's something we need to be prepared for. Janet Yellen is back in the mix. We know her stance. I'm going to stoke the fire a little bit more that Jack put some water on. We don't like watering down fires sometimes. Kidding, just messing around. But, if she's back in the mix, she wants to see these interest rates at least a little bit up. And I don't think we're talking, back to where we were 3 years ago, I think, or 2 years ago. But I think if we kind of give a little bit of just a small uptick in them, that could maybe calm some nerves. And I think it's inevitable. I really do.
Well, we need it too at some point, just because, just from the general health, everyone loves low interest rates, but the problem is that you end up embarking on a lot of projects and capital expenditures that are of dubious quality, that maybe shouldn't be made, because people are like, who cares? When the interest rate raises, you got to become more selective. It's kind of like what we tell our traders to be more selective with their trading, like avoid over trading, lower the interest rates. It's over businessing pretty much. People will pay for anything. It fuels. That's how you get the huge bubbles, right? Like through the Greenspan stuff. People start doing crazy stock buybacks. It's all a big party, and then it collapses. So hopefully we're not at that point. I'll leave it there.
Absolutely.
So I guess for our traders, like if you're a day trader looking at this, I guess kind of what Mick said about the grains, there's some other products that could show some action now, right? We won't go into a lot of the long-term investing things with it because inflation is tough to deal with as far as that goes. But if people are interested in, say, getting into some other commodities or grains, Mick, where do you think is a good place to start, or which one of those is the most liquid?
Well, corn and beans, they're all pretty liquid if you're looking at wheat, corn, and beans. I think, for any trader who's going to be taking on the grains, don't start with soybeans. It's priced at twice the price of corn. So you're going to see, as far as percentage moves go, you're going to see larger swings in there. I think corn's a really good place to start. Smaller ranges in there. Granted, we've seen quite a bit of action in corn, which is, high. It's high risk right now. But if you're going to start with something, start with corn. It's an extremely deep and liquid market, high volume on the day. So that'd be a place I'd look.
And they're starting to plant it. I've been watching the farmers out there starting to plant the corn. So it's around the corner. Some sweet corn. I'm looking forward to it.
And I think we've got crop production numbers out tomorrow too, 11 o'clock a.m. Central Time.
Yeah, that's how often do they do that? Every month or every
month? Yes.
Okay, so that's like the big sort of unemployment number for the indices. The crop production's the big one for corn, right?
Yeah, there's usually a fireworks show that goes on during those.
Yeah,
and you can stay in tune with the crop progress too. They come out with the crop progress numbers every Monday. You can see how much of the crop is planted in which states, and whether or not we're ahead or behind previous year or previous 5 years. So you've got some data, some fundamental data to check in on every week there too.
Yeah, and other incredibly deep and liquid market you could trade in futures. The most liquid, as my memory would tell me, is 10-year treasuries. Those are obviously very sensitive to these things too. And it's good just to be aware of them, because if you're trading stock indices, keep an eye on that 10-year treasury yield. Okay, we're past 1.6 now. 1.5 was a big psychological barrier that I think that's kind of what's getting people talking. That and the oil are what's getting people talking a lot about inflation. So these are the sorts of things that can break trends, right? We've had a pretty easy year of trading indices. If you're following the trend, if you're long, you've been killing it all year. But these are the sorts of things, these are the big sort of macro events. They can maybe turn that around, have NASDAQ take a breather. So really keep an eye on that, especially if that starts spiking.
And one thing I just want to add into this too, this idea of inflation and trading around the idea of inflation, it's not so much of a day time frame trader mentality, right? We're going to talk inflation. We're going to start to see some numbers coming. We're going to start to hear this conversation continue to hit the headlines. But when it's not being talked about, don't come in expecting that, oh, markets are, stocks are going to sell off because inflation is the talk. Inflation, indices are still going to want to try and grind higher. Good news is going to press them higher. So you want to keep that in mind as a day trader. Now, I know everyone out there is doing some personal investment stuff. Maybe you are, in some index funds. That's when you can start to think about how inflation is going to affect these and where do I transition, on a macro standpoint, because day trading is so micro. You got to focus on the news of the day and what's coming.
Yeah. And start watching the CPI number. That's the one thing I would change now, is start watching that CPI number.
Yeah, and to add on what Danny was saying, Jack, I agree. Watching that CPI number, anytime you're talking about fundamentals in a market and direction, fundamentals take a little bit of time to play out. It's not like in this world where news comes so quickly, where you see a tweet and there's a short time frame jerk reaction to that. Fundamentals, it's the makeup, one of the makeups of the price discovery in these products. And, it takes a little bit of time to play out.
Just want to give a quick shout out here. We got Chris coming in. He starts step 2 tomorrow morning and he loves Top Step. So thanks for that, Chris.
Give him hell, Chris.
And then level 2 is just asking, in your opinion, which is more important, the 10-year or the 210 spread? I think personally, the most important thing is the 10-year over a spread between two. So I think the 10-year is a little bit more important than the spread, personally.
It certainly garners more attention. Like, that's the thing everyone's kind of talking about. The spread's important. I mean, and correct me if I'm wrong, Mick, maybe no one does, but our traders don't really trade spreads. So
no spreading.
But could you theoretically, could you go could you do a 210 spread? Are they technically different products?
Technically different products. So you could leg in and out of those. There might be a market for that. I'm not sure. I never spread the financials. They might have something like that, but
you honestly need more just by you're so hedged in some of these, maybe not the 210s, but with a lot of these, it would be kind of a boring trade, I think, for the size and stuff here. You got to put on a good deal of size to make that something to look at.
Yeah, definitely. I'm glad you mentioned that too, because when you talk about 2, 5s, 10s, and then there's the 30s, the further you go out on the yield curve, the more price movements you'll see, because it's 30 years out compared to 2 years out.
God, level 2, you gave me some PTSD there. I was just thinking about, we used to trade those like 5, 10s, 30s spreads. So you'd be long the 10s, short the 5s and 30s at some hedge ratio, and that was always trouble. That'll turn your hair gray early. I got out at the right time on that.
Or it just starts falling out like mine.
Yeah, or you just start falling out of windows. But anyway, thanks for asking that question, level 2. So we'll be kind of talking more about this because it's going to be all over the financial news. And as you mentioned, we have a friend of the show coming on next week who is a commodities superstar. And she's going to share some knowledge with us. We're going to talk some more about commodities and trading to see, because they're kind of coming more into the zeitgeist. So definitely come in for that. Anyone else have any final thoughts here on our inflation? I can't think of a word that rhymes with it. I was going to try and do that, but
I just think it's going to lead to some interesting opportunities this summer.
the inflation temptation.
There you go.
That's what it was.
And that Fed funds rate, it kind of looks like they're already sort of maybe pricing in a rate hike sometime in 2022. So keep an eye on that also.
Yeah. And just to bring it full circle, don't go, this is not our day traders much, but like with a 40-year track record, it has been a real drag on people who have been hoping for inflation for a long time. So be judicious with that as you go try and do something like that. But Dan, I heard we're going to hear something from Mr. Pierpont Morgan.
Yes, this one comes from JP Morgan. I don't know. I was trying to think of something fun today, and with commodities being the talk here,
Nothing says fun like JP Morgan.
gold and silver are money. Everything else is just credit.
Well, did he own any Bitcoin?
You know what? He probably someone in the lineage has a lot of it at this point.
I would think so. Yeah. Well, that is a good that's a good commodities viewpoint. So guys, thanks for joining. Hoag's not here this week, so I'm trying to think. Dan, you who wants to take the sign off here? It's a big.
I think we give it to the dancing bear.
Hey, love it. Thanks. Yeah, this could all end tomorrow, but like Jack was saying, we're probably just playing some catch up right now. Keep an eye on the Fed, and let's face it, every dip's been a buying opportunity the last couple of years. I'm not saying that's over, but stay diligent, everyone. That's it. That's my best Hoag.
Stay diligent. That'll be your thing. We'll see you, everybody next week with our special guest, and trade well, everybody. We'll see you then.